We're good. Awesome.
All right. Good morning, everyone. How are you today? Thanks for joining Nick.
Gotta let everybody in first before you tell them what the $1 million secret.
Whatever. Sorry about that. Letting everybody in here. I just congratulated for everyone being here, but I forgot to let everyone in. So anyway, good morning. Glad you guys could make the call today. Nick did some updates on the spreadsheet and wanted to go through it. That's kind of our main topic today. We're going to do a little housekeeping real quick while you guys are hopping on. Obviously, if you guys like the call, if you're on the call and you missed something, the replay is in Facebook. We're live on Facebook, and a replay will be there. We also send out the replay, Elvia does. And then, so that's about, and then it's real important, just so you guys know, if you guys haven't purchased or have interest in the course, we're doing updates. The pricing is going to go up, but it's really, really important. Just so you guys know, when Nick and I are we're able to help you sell your first liens at premium pricing, that you've gone through it, because we've been spending a lot of time helping people dispose of their first liens that haven't even gone through it. So that's going to
have to change, because we don't have enough bandwidth to help the people that are in the group, let alone that are not. So because what happens is, when you don't follow the protocol, we lose control, and when you lose control, you lose the velocity of the deal. I just had a conversation earlier on this morning.
Yeah, well, example, we had a deal that went to the wrong title company, switched the title company. They're paying hard money. Took them 2 months. They did everything right. They found the buyer and found the seller and had a great deal, but it took 2 months to close the dang thing because all the protocols were off and they didn't understand what we were doing. So
let's talk about why this is really important. Let's talk why that's super important. Okay. Let's just say that was 100. Let's just say an investor, the note creator, had $100,000 and they invested that $100,000 into that one deal, right?
Yep.
They got the buyer, they got everything, they agree to the manage the transaction, exit out to do it. Okay. Well, guess what they can't do? They can't go get the next deal until that one is closed and funded, and they get their capital back to go do another deal. So think about it. If it takes you an extra 30 days to do the goddamn deal, how many deals do you lose the opportunity to do in the course of a year with that same capital stack? That's why velocity is the most important part of this, plus the chain of custody and the files, because the custody of the files, which is all the stuff we're talking about, the transaction management, the promissory note creation, the servicing, the underwriting, all that stuff creates paints the picture. The better picture we have painted, the quicker we can get through it, the quicker you can get paid, the quicker you can do the next deal and make more money. That's the point that we're doing. And that's not even taking into consideration the dollar value of the premium pricing as a result of it. That's just the velocity side of it. So guys, choose to do what you want. But as we go to the 2.0 version, which Eric and I were going to release in October, the structure is going to change for the people that are not included in this thing. We're going to have a certification. You have to get certified to be able to do this. So we know, Eric and myself know, that you know what you're doing, because it's in our best interest to make sure you know what you're doing. It's in your best interest to know that you know what you're doing, so we can get in and get out of these deals. Because I'm telling you right now, look, who's super excited about tomorrow? Does anybody know what tomorrow is? Because I'm ecstatic about tomorrow. Can anybody raise their hand and tell me what tomorrow is? Okay, who's this up here? Jonathan, unmute Jonathan, see if he gets the answer to my question right. And I want him to tell me why I'm so ecstatic about tomorrow. Jonathan, what's tomorrow?
Rates are going up.
Rates are going up.
Rates.
I mean, it's like Christmas in July. There's not a better thing that can happen to what we do in our business than rates go up. And if you don't understand that, or you don't know why, you haven't been listening to what we're talking about, and you need to go get the masterclass and learn it, because That's the best thing in the world that can happen to us, in my opinion. I'm just one person, but I have been doing this a long time. Rates going up is a great thing. Look, I don't wish ill will on anybody, but the fact of the matter is that, you know, if you have the ability to solve a problem when rates go up, that's a good thing. Okay.
Listen, you're not wishing ill will, because we have solutions for people that'll make them more money than they've
Yeah.
ever made with little to no risk with that
Dude.
said. But real quick, one more housekeeping thing. Just so you guys know, Nick and I, we're in the business of doing deals on a regular basis. We do this call every week. We don't charge for it. We want you guys to understand and learn what we've done that's worked for us successfully, and as the market changes. So when you're in our Facebook group, please be active in there. Put all your questions in there. We're not going to probably respond every 24 hours, even 48 hours for that matter. But what we do is we gather all the information that you guys are sharing in there. If you have deals or examples or case studies or whatever, put them in there. Then Nick and I pull all that stuff out. We take the top, as many as we can in the time that we have, and then we share them with the group in a mini model. It's just way more efficient than responding back and forth on chat. So we're not doing that.
And to that point,
that's
Eric,
been super successful for the group as well.
you got 5,000 people in the community, right?
Yeah.
They're your bigger, they're the bigger resources and assets to you than Eric and myself are. I mean, in all honesty, because like somebody asked, hey, anyone looking to buy and hold a deal? I have a property in Memphis, Tennessee. Well, I don't do deals in Tennessee, but I know about 100 people that are in this Facebook group that are in Tennessee. They're your partners.
But hey, not to go on a tangent, but our servicer is going to start working out of Tennessee, right? Is that one of the ones?
Tennessee is already there. Yes.
Yeah, we are. Okay, good. We've taken our master servicer that we use in Texas and in Arizona, and we're helping them expand because that's what you guys need. So it's really, really important to have a servicer that understands what we do. It's so
that's all going to be part of the 2.0 release that comes out in the 1st of October.
Okay.
All right, let's get a few questions and I want to get into modeling. All right, so question says, I was on the Nick's call last night, analyzed a deal. He said to add a deal to the page. I have a deal in Akron, Ohio. I'm not going to comment on Akron, Ohio, but that's fine. Purchasing for 80. Hey, it doesn't matter. It's worth $1, between $1 and $1 million. And there's money to be made in Akron, Ohio, just like there is in some of the other states. So the question was, don't know exactly how to I don't know how to fund the deal, and then I don't know exactly how to structure the notes. Well, first of all, you got to fund. We talk about these things all the time. There's 4 things that you guys need to do, and only 4 things, and then we can help facilitate the rest. Number 1, you have to find the deal. I'm not going to show you how to find a deal. Okay, this is advanced math. I'm not going to teach you how to do basic addition and subtraction. You guys have to learn how to do that yourself. If you know how to do it, Google it, YouTube it, whatever, how to find a deal. Okay. Number 2, you have to be able to analyze the deal. That's what we're going to talk about today. We're going to go through the analyzing software and show you how you can quickly identify whether or not it's a deal or not based on our exit strategy. Remember, it's one of multiple strategies you can do. The 3rd thing you have to do is you have to fund the deal. We're not funders. Okay. Every state's different. Okay. California funds deals differently than Arizona, than Ohio, than Texas. We're not funding. If you go to the resource tab, there's a list of some lenders that might be able to help you out. We don't make anything on it. Don't really care, but you need to source your own funding of deals. And the last thing you have to do is you have to find the owner finance buyer. Again, in 2.0 that's coming out in October, we will have some other additional resources that allow you to partner with them to help you disposition your properties with seller financing. Again, that's not what we do internally, but once you get to that point, then it kicks in for us to manage the back end, to help you structure the creating of the notes, to help you underwrite the note correctly in the buyer, to get premium pricing, to get the note sold, to stay in the deal, to get paid cash now, cash flow, cash later. That's what we try to do with infinite ROI.
Hey, real quick, Nick, the reason we have 47, almost 5,000 people in our group is because everything that Nick just said, finding the deal, analyzing the deal, funding the deal, finding the seller finance buyer, there's a solution in this group. Somebody in our group is doing one or all of these things. And so that's why we created this community. and it'll be super helpful for you. So if you have any questions or needs, or if you can't find a lender, there's people in this group that's what they do. And guess what? There's a lot of private investors in this group that have IRA money that would love to fund your initial deal, knowing you have a back end exit structured the way Nick and I that we talk about. Okay. So that's one main thing. So that's it. So let's get to the model.
Couple more questions and I want to get to the spreadsheet. So Bob asked, where do I find the replays? Okay, so Elvia, I believe she's putting them in the resource tab. So if you don't mind, Elvia, just putting that link in there. I'm pretty sure, Elvia, is there a link for the, I'm not looking at the screen in the resources. Does it show previous recordings like on a tab, or where is it looking?
Is the second one at the top? It says office hours live.
Okay, so that's where the recordings are.
Yep.
Okay.
That's where all the replays are. Plus they're in Facebook.
Plus they're in Facebook. Yeah, you can always go back and find them in Facebook. All right, that's a couple more questions here. This is a great question or comment that Alfred made. Getting a loan is one thing, closing it is another. Okay. What I love about this is that what I love about hard money lenders, we talk about this all the time, why I'm not a fan of private lenders and I like hard money lenders for this, because they're an extra set of eyes and ears to make sure, hey, you guys are on somebody's live has a live mic, just mute it out. I think it's Simone. Thank you. So the reason why hard money lenders are such a valuable tool to what we do is because they're not going to lend you money on a crappy deal.
Right.
Okay. I know many people will say, oh man, my lender won't lend on it. Well, that should be the first red flag, because most hard money lenders are professional lenders and they're not in the business of making bad notes. They're not in the business of writing a bad note to you as the borrower so they can foreclose on your property and take it back. Contrary to popular belief, it's not what they do.
So the other thing, Nick, that we've always discussed, and so if you're new to the call, but let's say you pay 12.9% and you're in and out of a deal in 90 days or less. Does it really matter if it's 8, 9, 10, 12.9? It doesn't, because you're in and out so fast. You're making that. Now the lender's getting his fees and points and whatever. That's your own negotiation, but it's still irrelevant in regards to the velocity that we talk about here.
Yeah, absolutely. Okay, a couple more questions. This is from Gene. This may have been answered already. It says, when you sell your property or owner finance, it's how do you pay real estate agents when you sell your property? Well, it doesn't matter how you sell it. You're paying them the same. You can pay them whatever you want. There's nothing that says you got to pay them anything, but you probably should make it fair and equitable. Otherwise, you're probably not going to get them to help you do what you need them to do. So
it's kind of, I heard this today. They're like, oh, I work at a brokerage and I want to do a 90-10 split. Okay. So I'm the agent. I'm giving my broker 10, I get 90. Everything's great. Well, by the way, the broker has lead flow and he's got 50-50 splitters over here. How many 50-50, how many 90-10 splits are you going to get in leads if you're trying to take all the money? So the value, you find good realtors in your market that have seller finance buyers. It's got to be fair. Nick, you started at 2,500 in your market. Now you're at 4,500.
Sometimes $5,000.
But here's the best part is they love you because we can close our deals in 2 weeks. So think about it. They can just keep closing deals over and over and over and over again. They're not going through all the BS that's happening right now in the market, and the buyers are ready to buy. So they have a velocity factor too that they have to look at. So you can get a better deal, but just explain to them the velocity, right? So
yeah. So to the other part of the question that Gene was asking was, how do you pay them, right? So he was asking, do you pay them from the down payment that you get from the end buyer? Well, absolutely. I mean, remember, we're going to get cash from the down payment of the buyer. That's why in the model, we'll go into that in a second. When you see the net cash line, that's exactly what it's doing. If you ever just take a look at that number and sort of follow the map, you'll see exactly what it's doing. That's why you get $20,000 down payment from a buyer, but the net cash is $4,000. Well, why is it? Well, because there's costs and there's marketing fees and there's hard money fees and closing costs and insurance and all that other stuff that rolls up into that number. Okay. I say I pay my agent out of the down payment, and then the buyer handles paying their agent fees on their own. Well, again, it's just part of the deal, right? It doesn't really, doesn't matter how it's structured, it's still coming off the bottom line. So how you wanna, if you wanna charge your buyer less down payment, so he can have $3,000 to pay his agent, fine. If you wanna have him give you an extra $3,000 and collect it, then disperse it on the HUD, fine, doesn't really matter. There again,
I mean,
those are all simple.
Nick, in the past, we've said, okay, you have 40,000 down, that'll cover everything. So there's no like unknowns on closing, because some of our buyers are like, I have 40,000. You know, they don't want an unknown with closing costs and all the other stuff. They just need to know their down payment and their payment, and that's it. And so then you can back in. It's a flip. And you're just left with a friggin' second lien paying you 10.5% or whatever. So it's a great model. You don't have to overanalyze it too much.
Right. All right. I'm going to share my screen. Let's get into any other questions before I get into the model. Okay. Oh, Jonathan raising his hand like a lunatic up there. Unless he's going to write me a check for $1 million. I don't know if I really want to ask him what he needs, but go ahead. Jonathan.
What is happening, young man? How are you?
Good. How are you today?
Good. So, we kind of touched on this one time before. Using a novation with your process. So instead of going and getting hard money, kind of incorporating a novation into it, so that we don't have to get any funding whatsoever, have the seller hold the note for the period of time that we need to get everything done. Can you just comment on that or detail anything about that?
The short answer is no, I can't. Actually, I can, but I'm not going to. We got a lot to cover today. We'll probably bring somebody
Hey,
on.
Nick,
in the next-
hey,
no, I'm gonna
John,
answer the question.
John,
I can't answer that. Okay, that's the problem. Novation agreements are good. We can do them. That's part of the 2.0 version. Eric, do you want to add anything on that?
I
really
do,
don't.
because we're gonna go through the spreadsheet and just act like instead of hard money, you've let the seller carry and come up with your own scenario on it. But novations to note sale model is fantastic, which will be in our new in our added to this, because people are talking about novations. It's like the new thing. It's not.
It's the same as sub 3. I mean, it
Yeah,
doesn't
it's
really
not
matter.
sub
It doesn't.
2. Here's what I will tell you is they're not. Nobody really talks about the first and second disposition model. So that if you just can put it in there, I will tell you, Jonathan, that I love whenever a seller with rates going up and you could give the seller some income, you could literally triple your cash flow on some of these deals, especially the higher ones, you know? And so you just got to make sure you protect yourself on the exit. So the answer is,
at the end of the day, it doesn't matter how you acquire. You can acquire it with cash, private money, hard money, seller finance, sub 2, sub 3,
option.
novation, hybrid. I don't care. The key to this is the exit, the creating of the exit to protect yourself in the event of whatever could happen down the road. Because when you're writing, you're borrowing short and lending long in a lot of situations here. When you borrow short, hard money, private money, okay, so even seller financing on balloons, but you're lending long, that's not a really good business model. It's not most people tell you that's not very, you're not going to be in business long. However, if you structure it so that you could treat it as borrowing short and lending short, which is the creating of the note, liquidating the first lien, and getting out of that debt position up right away whenever possible, then you get to stay in the deal long term on a free and clear with a free and clear asset that produces infinite ROI. That's the model. So we don't really care. That's why when we talk about it, I don't care who you learn from, on what strategy you learn on how to go get a deal. They're all great. I bring them all on, because be able to structure it on the exit is the more important than how you acquire it.
Yep.
That's
Yep.
all I'm saying.
And I, novation, whatever you want to call it, you're getting the seller to give you time to go find the end buyer with the largest down payment possible. And then the best part is you're like, oh my God, Mr. Seller, how about an extra $250 a month on this amount for the next 5 years, 10 years? Now you're still borrowing short, selling long. But if you got that 10% first lien and a good quality borrower, I still feel you have an exit. So you can, there's risk there though. That's risky. We teach no risk, which is get out of the dang first lien and have zero cost in the deal. But if you want to have a little risk involved, which Nick and I do from time to time, when the cash flow goes from 300 to, you can, when we do the model, you can just put a 3% 30-year fixed loan in there that you arbitrage at 10%. You can figure out the math on that first lien. It's when you're doing it, do it as a case study. Use your calculator right now. It'll be shocking, not shocking. It just is. It's friggin' amazing. And so that's where the world's going. And our sellers that have 30-year fixed debt, that's their biggest asset. And so if you can help them make money and structure it correctly and protect from a due on sale. And I'll just tell you right now, I have a seller that I did I sold on terms. I wrapped it, created a first loan at a 2.5% VA loan 5 years ago. And I'm getting their email. I got an email this morning, right before this call, with they're trying to refinance to lower their payment. They're not trying to cash out, right? And the lender, first I got authorization. The lender goes, "What are all these liens? Well, why are all these liens there?" I'm like, and so I don't have to explain to them right now, but we just wrapped it and we fully disclosed it. We fully do it. I have the ability to pay it off if there's a due on sale. So anyway, that's the deal. So let's get into it, Nick, because this is
all right. Let's go.
Good calls.
All right. And if there's anybody, so I'm going to go through the model here, and if somebody wants to has a deal that they've already downloaded and put into the new model, and we want to go through it, we can do that as well. So I'm going to share my screen, and let's get right into it.
And
okay?
while you're doing it, Joe had a question on the certification. We'll go through that later. It's not like
it's not important right now.
It's not important. You'll understand it, but it is important, but it's not something that we want to discuss now. It's not crazy. It's nothing special. We just want you guys to be in the game so we can help you. Right. That's
right. All right. So I can't show this, but if you go to cashflowdealmachine.com, it'll ask you to download. So make sure you download the most recent version. You can always check it. It's always the newest version is always live there until we change that, which when we go to 2.0, I'm not sure if this is going to be available anymore, if it's going to be part of the digital only or a standalone. I don't know. But for right now, you can download it, no charge, and you can use it. Okay. So it hasn't really changed much from the last time, except that we've added a couple new modules. We're going to go through it here. Okay. So I'm going to go back to the beginning and just do a refresher course on the spreadsheet, how to use it, and how to analyze the numbers that come through it. Okay. So it looks to be very intimidating when you first see it. Okay. At the end of the day, the only things that are really, really critical to know are the yellow. Okay. Those are your variables that we have control over and we're going to put in. Okay. Everything else is either a calculation or another formula. In fact, I went in and blacked out down here the wholesaling, fix and flip, and sub 2 dispositions because I'm not supporting them right now. And we might do it in 2.0, but for right now, I'm not doing it because it's just not, it doesn't make any sense to do it. So let's just go at the top. So first thing you want to do, you have to do this, guys. If you don't do it, you're going to screw it up and you're going to want to know why you have a problem. Is go down to the master tab, okay? And you're going to click on it and you're just going to go and you're going to duplicate it, okay? It's going to pull up a new one. It's going to say copy to master. Just rename it, whatever your name of your property is, okay? So you call it 123 Main Street, okay?
This is the hardest part because you guys have to lift it over.
Hey, guys, everybody mute. Hey, so, Elvia, make sure everybody's muted. I don't know who's talking, but I can't have 75 people talking if I'm trying to talk. Elvia, just make sure everybody's muted, okay? Just redo it because what you want to do is you want to create it and then you have all your properties on the bottom. It's one spreadsheet. Put it on the G drive and you get to keep it forever, okay? I will go after. Remember, this is a forecasting tool, guys. Really, really important to understand.
Gentleman that came here last time, he came with 2.
Elvia, please find out who's got an open mic.
Yeah,
mute it.
I muted already, but
Right.
I
I
don't know
just
why.
mute everybody, okay? Man almighty. Otherwise, we're just gonna kick people off because I don't have time for this. This is really important for the people that want to learn this, guys. All right, so this is a forecasting tool, right? This is all we're doing is trying to predict the outcome in advance. So up until 2 months ago, it was really important to be able to use this quickly, right? Because you didn't have a lot of time as a buyer to sit there for 3 days and evaluate a property because it would be gone if it was a good deal. So you would just be able to come in, enter these few numbers up here, and it would give you an analysis on how you wanted to move forward. So this is the blank spreadsheet, okay? What you do, and we're going to go into the examples here, make a copy of it, rename it, And then what I like to do is when I get to the actuals, we go back and do it. So what I will tell you though, is that the spreadsheet is modeled very conservatively. Okay. It's, for example, it's modeled with the 4% sales commission. Okay. You could sell it yourself and not pay anybody, right? Leave it at 4%, because if you can't sell it yourself and you need to outsource somebody, a realtor, leave it at 4%. If you're fortunate enough to sell it at 2%, when you go to the actual, change it to 2%, but don't model it at anything other than this, because this is the minimum that we want it to be. Same thing on here. If you have hard money cost differently than 12.9 and 2, well, then set your baseline there. That's what my costs are. I'm only in and out of this deal in 60 to 70 days. I really could care less if that was 20, honestly. It could be 25%. I would still, it doesn't matter. Doesn't change anything. Okay. Such an insignificant number relative to the model. Okay. That's a variable though. The note ratios right here, which we're going to show on the next screen. These are variable, right?
I can move the couch back.
All right. For the love of God. Help you. I mean, seriously.
How are they?
All right. Thank you, guys. This is like freaking the comedy show at the Improv. And I'm not even the main headliner here.
No,
Eric's so nervous. I think he muted himself too. I think Eric put himself on mute.
I did not mute, but I think it's funny. Anyway,
It's,
go ahead.
it's funny to a certain extent, but we don't want to encourage people to be funny, because then Jonathan will be funny and Keith will be funny, and all of a sudden we got a laugh track that we got to figure out what to do with. I see Jonathan laughing when he's not even muted. Thank you for doing it. Thank you. All right, let's get back to it. So these are variables right here. Okay. We remember we changed this from 75 and 90.
You run this out to the
she is jumping the call. I mean, it's leaving the call and jumping again. That's why.
You know what? Just remove her. Okay. If
All right.
she can't be responsible for the group, just remove her. I don't care. Look, tell her I'll give her her money back. Oh, she didn't pay anything. Sorry. My fault. I'm just kidding. No, but seriously. So these changed, right, guys? This used to be 75 and 90. Why did we change it, right? Well, we changed it because the market is no longer trending upwards from a predictability standpoint on value. So like, remember we talked about what note buyers buy? They buy risk and they buy the yield, right? So we have to prevent ourselves from giving up too big of a discount, because we never get that back. And we'll show that in the next thing. So a couple other things on the master. We're going to talk about this new green box right here. It's probably the biggest change. The optional exit. This is a forecasting only. Talk about that. And down here, you'll see the links to all the resources. So let's go in. I have two examples on here. I'm going to leave them on here. The first one I'm going to call example 1, which is positive cash, which is the traditional model that we've been teaching and showing, where a lot of these deals used to fall with positive cash at closing, which is the cash now portion, right? We talk about cash now, cash flow, cash later, infinite ROI, no risk, no leverage, no debt, right? That's how it used to be. Those deals are becoming harder and harder to find, because we got to write the first lien at a smaller number. Doesn't mean they don't exist. It's just how we shift the structure. Doesn't mean we lose money. It just means we don't get as much cash today, at least on the surface. So let's look at this example right here. I've already filled all the data in. So what we're going to do here is we got the address in here. Guys, I recorded a tutorial video right here. Just go back and watch it, okay? It was one I recorded where I didn't have everybody jumping in with an open mic, interrupting what I was saying. So
No, he reshot it, or we did. It's really, really good. It's a little more.
go back and watch it again. No, seriously, it's really good. And I missed a couple little things, but 98% of it's pretty good. So let's just talk it. What I did differently on this sheet, as you notice, there's a lot of pink now. And the pink is just, those are really the when you analyze this, are things that you really, really need to look at, because they're different triggers or different checks and balances in the model. Okay. So let's just start at the top of this and just walk through it slowly, so everybody has an understanding of what these do. So the acquisition price is what we're going to pay the seller, either directly to the seller or through a wholesaler or however we get the deal, right? 110. Sale price in this example is 180. Okay, I put $10 in the repair only because if I put 0 in, it doesn't show, and I want people to understand that that's actually there. So for illustration purposes, I just leave it at 10. Okay. So as we go through this, the first thing that I want you to see is what the minimum OFV. OFV stands for owner finance value, not as is value, not ARV, owner finance value. Why is that important? Because that tells me if I go through this whole strategy and structure, that if I can't sell it for at least that minimum number, I'm probably going to have a hard time structuring the deal. So that's your first hurdle. So in this situation, my sales price, my forecasted sale price is $180,000. That's greater than 157. So far, I'm good. All right. That's number one. Let's go down here. 9.75. These are the default rates. Again, I don't know what usury laws are in your states. Don't worry, you're doing it. You know, you can check that out. You can use the transaction coordinator and the RMLO to figure out where you need to be on that. Check it. But right now, with rates being where they are and things changing, you should have no issue with this. But I'm not a financial advisor or a consultant from that perspective. You need to do your own due diligence. Okay. So I've got it at 9.75 is the
Nick, real quick, let me just
Yeah.
interrupt. The important part is you got to have the affordability factor, but we have a huge benefit that we're able to get better deals now. So I think it'll average out. So anyway, go ahead.
There's no issue getting deals right now. I'm just
No.
telling you. It's just figure out which deals you want to do. Because I'm going to show you how to exit out of it in a second. Hey, here. So as we go through this, okay, ZHVI. We're talking about ZHVI. So I'm going to pull this up real quick. ZHVI is the Zillow Home Value Index. Just something that I use. Okay, so I'm going to just go pull up Zillow Home Value Index right here. Where's my Google link? Did I move it? Oh, here it is. Oops. I got this thing's in my way up here. So I'm going to go pull this up. And I'm going to go in here and I'm going to put ZHVI. And I'm going to put a zip code. It's just going to show up for illustration purposes. First thing that comes up, it says Zillow Home Value Index. And I just want to explain to you why I think this is important. It's just a tool, right? There's no bearing on it. So this particular zip code is in Dallas, Texas area. Okay, it's in the suburb. It's Mesquite. You can see the line of the zip code. The average Zillow home, the Zillow home value is $265,000 with a 1 year change of 25%. Now that gets changed monthly. So right now it's given us 25% between September of this year and September of last year. Next year will be October to October, and so on and so on. This number will likely come down. But why is this number important? Because this is the median value. This is the median point of that zip code. So if you have a bell curve, it's right at the middle. That's what it means. So that means some properties are priced higher, some properties are priced lower. Okay. All that means is that if we have a note that we're going to sell and we want to buy, we prefer to be on the lower side of the median, not the higher. Okay. More buyers in the event of a default. We have more opportunities, a lot of things. Doesn't change anything. You can go sell a house for $330,000 in this zip code and be just fine. But what we're trying to do is deal with the masses here, right? Now, I would say I would probably go comfortably 15% above that number. Okay. I would say I'd go to 65%. So 15%, let's call it another 25,000, maybe 280, 285 is where I'd want to be. If this house came in at 320, I'd really consider this strategy, at least taking it down with cash, unless I knew I already had a buyer that could qualify and buy that higher dollar property. Does that make sense? Okay. That's what ZHVI does. Okay. Let me go back to the modeling. Okay. So that's what this is right here.
But Nick,
And-
keep in mind, all these things that you're doing I mean, we're doing it slowly, but that you can just whip through this stuff fairly quickly if a wholesaler.
It literally
sends you
takes less
deals,
than a
you can
minute
go
to
boom,
put
boom,
this
boom,
in
boom.
and get an analysis.
Yeah.
Just
yeah.
walking through, explaining what the cells mean,
Or you
okay?
can hire someone to sit on a spreadsheet and actually analyze I mean, I got 5 deals sent to me last night that fit this exact model in my perfect market in the deal. So the opportunities are coming. It's so cool.
So down payment, I have it at 8, I have, this came in at 10%, okay? Minimum 8% is my requirement. I would recommend. Could you do less? Absolutely. But to do less means you're gonna have to write a smaller first lien, which means you're gonna have to carry a larger second lien, which means you're gonna have to invest more cash into doing the deal. And we'll show that as we go along. But if you keep it at, if you forecast it at 10% and you can make the model work, you'll have no issues passing it, okay? Flood factor rating, I'm not gonna go in that. You can go down to the bottom here. There's a link. It's really only important where, if you're on the Mississippi River, you're in a hurricane alley or something like that, you'll want to use the flood factor to get the rating, because what happens is that the insurance goes up. When the insurance goes up, that means the buyer is going to have to spend more money to make that same payment. So their ability to purchase, their purchasing power is going to decrease, right? Because now they're spending $2,000 a year on an annual insurance premium instead of $1,000. Well, now they just lost $800, or whatever the number is, $80 a month in a payment. Okay, that's why. So you need to know that when we talk about the affordability, you want to know what that is. You don't want to get any surprises, and make sure you can do that. That's what flood factor means there. Then we got the rates and terms here. I want you to default at 75 days, even if you're not doing any repairs. If you're doing repairs, you'll need to change that to whatever the appropriate is. Most of the stuff we're doing right now, where we're not touching it and we're not doing any repairs at all, and we're just doing maybe a basic clean out, we're at probably 35, 40 days. Remember, forecast, right? Forecast higher time, but have lower come in, because then you're never caught off guard. You're not ever at a disadvantage, because it doesn't seem like a big deal to put 40 in there, but all these little things adjust the point on whether or not it's a deal or not. So I moved it from 60 to 75. There again, it might turn out to be 30 days. Hell, it might turn out to be 2 weeks. You may not even contract it and buy it. You may just go find a buyer and create all this and do the same thing. Okay. So let's get down into the model here. Okay. Let's scroll down here. Oh, by the way, so if you're doing Texas notes right now, our minimum Texas notes are yielding 90% on the first lien. Okay. So right here, the model defaults at 72 and 88. But if you're doing a Texas deal, you can change it to 90.
Or Arizona.
More than likely, yes.
Yeah.
Okay.
That means that means that if you create a note, we'll buy the first lien at 90% in Texas or Arizona.
Yeah, I'll guarantee you I'll buy it for that if you follow the
Why
process.
are you yelling at me?
I'm not yelling at you.
Okay.
I'm getting a little sleepy here. I gotta pour some caffeine.
All right, go ahead.
All right, let's get into the good stuff here. So what does all this mean? Okay, so remember, we're looking at the pink. Let's take a look at the pinks first, okay? Because the pinks are super important to understand where we are in there, because these two numbers can be manipulated. Now, what I'm saying is that if this was Texas, you could change it to 90, okay? If it's Ohio, maybe not, okay, leave it there. But if you're at 72 and 88 on the modeling and the forecasting, okay, what does that mean? 72% means the note amount of the first lien, okay? So if you look at it right here, $180,000, the first lien value is $129,600. Well, you look at the formula, you do it on your calculator, that's 72%, okay? We can actually go up to 75, okay? We're never going to go above 75 because the investment to value is a critical analysis in the process, okay? Remember, this is a forecast. We haven't even found our buyer yet. But let's just say we do find our buyer. We send them to underwriting, and then we come back and we say, and we do what's called an indicative bid on the note to buy, because you followed what we told you to do. And we say, you know what? We can actually get you 75 and 89. Okay, because it's a strong deal, right? It's a good property. The borrower's got a 650 credit score. They put in 22% down, whatever.
Or, it's a fully rehabbed house. I mean, there's a lot
Whatever.
of,
There's a lot of things,
scenarios
right?
that go into it.
A lot of reasons. That's why, remember, forecast, but we don't know who our buyer's going to be when we forecast. We can assume we know who they're going to be, but every buyer is different. So now
Your
Well, that's
your
why-
buyer could be the neighbor across the street that cleaned your house and then he brought his family member in. That just happened to you last week, remember?
don't give away all my secrets, please. Actually, what happened on that deal, the guy that lived on the street, he said, I'll get back to you. And he said, and he just started lollygagging. I ended up selling it to another buyer.
Right.
You snooze, you lose. And I probably had 7 more buyers that would want that house for that price, because owner financing is king, man. There's nobody out there.
Who is your real quick? What when you say your buyers, who has the buyers? Your buyer's agent?
Buyer's agents or Facebook Marketplace or Craigslist or any of that stuff.
Oh, that particular one, did you
Bandit
sell?
signs,
I'm sorry.
Bandit signs. That one we've sold probably, I don't know, 30 properties within a mile radius of that house. So
You're because of your market and where you're focusing on, you have a sales agent already has the buyer. You just need the dang house.
always.
Yep. Okay. Just
But if I didn't have it there, I could very easily have gone to a disposition company or to a realtor
Yep.
that specializes in owner financing. I could have posted it on Facebook. I could have posted it on Zillow. All
No,
the
but
things. that we talked
my
about.
point to this is you've created a systematic process in certain areas that have sales agents that all they need is and then down.
Yeah,
payment.
because they're just going to turn around and do exactly what I just said.
Yes.
Instead of me putting it on Facebook, they're going to put it on Facebook. Instead of me putting it on, Craigslist, they're going to do that kind of stuff.
Not
That's what
my
they-
buyers agents in my markets that as soon as you have a vacant property, they'll do Facebook Live and have it sold within 10 minutes. It's unbelievable what's going on right now. It's so
Yeah.
awesome.
You
Anyway,
just got to
go ahead.
believe it, man. You don't believe it, then you're not going to get anything done. That's for sure.
Yeah.
All right, let's get back to it. So, back to this one. So in this example here, let's go down right here. So let's look at this purple right here. So the cash now is positive $2,158. So if anybody ever goes and watches the video, Creative video, that's this model. Okay. That's taking it down with hard money, finding the buyer, creating a first and second note, selling the first, keeping the second, keeping the cash, getting paid cash flow over time. So in this example, $2,158 is how much I make when I sell that note and pay off all my debt. And the cash left over. Remember, I took $18,000 in cash, but I only ended up with $2,100. Well, why is that? Well, because I had to write a bigger second note, and I didn't. If I were to wrote this, watch this. What happens? I change this to 75%, which is what it used to be. Watch what happens to my cash. Watch this number right here. Goes up to $6,900. Well, that's like the old model, okay? But look at what my second note is now. So it's just a lever, right? So if I go back and I change this back to the 2,900, the 27,000 goes up to 32,400, right? See, all we're doing is shifting where the numbers fall. But what we're doing by writing the 72% first is we're minimizing the amount of discount that we have to pay, or you have to pay, to get premium pricing. So instead of giving the bigger discount and taking the bigger haircut, we're doing it on a smaller number. And that means we get to keep the back end as more money. So you don't even understand the reason why these numbers are lower, except that it's not that you're getting less money on the deal. You're actually making more in perpetuity by having less cash now, because you're getting a bigger second note and it's amortized. And we already know that the return on an amortized note is about 3x if it goes full term, right? We'll pull that up here in a second and I'll show you what that looks like. In fact, let's just do that right now. So let's take this 32.4 at 9.75 And let's just show the impact of this on a note calculator, okay? Let me pull this up. So it was 32,400. 9.75, right? 9.75 is the interest. Net payment, 278, okay? So look at this right here. The value of this note in this example is $100,000, guys. Think about that for a second. $100,000 is the lifetime potential value of that note. What's our cost basis on this? Our cost basis is zero. In fact, we got paid to do this deal, $2,100. So if you can make $2,100 on every deal you did, how many deals? This is a question for Jonathan. I don't know if he's going to have to get his calculator out on this, but let's see if he gets the answer right. Jonathan, how many deals can you do if you're making $2,100 a deal before you run out of cash? He's speechless. He's speechless. You don't.
I'm not clear. I'm not clear on exactly what you're asking.
If every deal you did, you made $2,100, how many deals could you do before you ran out of money? I can't believe he's not.
Me personally, 10.
If you got $2,000 every time you did a deal, how many deals could you do before you ran out of money?
I'm
Unlimited.
out of money. I'm making money. What are you talking about?
It's
I'm
That's
making
my
money.
point. That's the whole point. You never run out of money, so you can always do the deals.
It's the
Jonathan, send me all your
model.
deals over 10. Anything
It
over.
wasn't really a
10 to
trick
me,
question, guys, but obviously people took it as that, okay?
It's the
Following
Burr
the
model
math.
on steroids
The
without
math.
owing anyone any money.
Everybody's worried about how much money it's going to cost them out of pocket to do deals. We're showing you how to do it without, okay? So that's why we do it. So going back, let's go back to this calculator for a second, okay? So in this example, let's look at the potential profitability on the deal. Well, this is the 10-year projection, but the note value, we go back to this note, over 30 years, could have received $100,000 on doing that one deal. Okay, that's the number. No cost.
Hey, Nick, let me give you a real life example. So I had somebody, my net cash flow, because I did a wrap on a VA loan. I think it's around 550, and I've been getting paid for almost over 60 months. Okay. So I've already made $33,000 in income off that one property, and they're going to refinance because, well, I'm going to try to talk them out of it because I control the debt at such a low interest rate on the wrap. But anyway, if they do, I'm still going to get a windfall of another $33,000.
Yeah.
So
that's great, but the problem is,
I mean, I wish I kept the 550 cash flow, but it's okay because I'll take the
But there's
33 grand
risk,
and go do
okay?
it again.
risk. The big difference between
No,
risk.
no, I know. I'm
We're
just
talking
telling you
about
that's
no
what I
risk
do.
here. I don't want to confuse everybody. You're right. You can make, there's no question, guys, I'm gonna tell you right now, there's no question that you can take this model right here and make more money. Okay, there's no question about it. That isn't what we're discussing here. We're discussing is, do you want to make $278 a month in perpetuity for up to 30 years with zero risk and no leverage? Or would you rather make 350 and be exposed and have risk? It's a personal question. Only you guys can answer it. But I tell you where my position is. No risk, no leverage. Because Eric, you were around in 2008. What happened? What happened to leverage in 2008? All that money that was borrowed out there. What did your leverage go to?
So my story is, my goal was $10 million worth of debt with $20 million worth of real estate, which is exactly what I did.
Well, that's
And
a
then it
50%. That's 50% leverage. That's pretty good.
So I was doing great. And then it went from $10 million worth of debt that I was on the hook for, that I signed for, okay, to $10 million worth of debt with $5 million worth of real estate. So
Is that a good investment strategy?
wasn't a great feeling. It wasn't a great feeling. Now, guess what the best part is? I had deals where I actually gave the properties back on sub 2. Okay. I won't go into that. And I leaned the property that I had no cost in. And guess 11 years later, I'm starting to get all these windfalls of cash, but I didn't have any at that point. I had no risk. So people ask, well, oh my God, what if the market crashed? You know what? If you have an owner occupant that wants to stay in the house and has an affordable fixed payment for 30 years, they'll most likely, the numbers are in your favor. They'll probably stick it out because it's affordable, because it's less than what rents are going at, right? And then you'll ride that deal out, and then eventually you'll get a windfall of cash if that happens. I'm not saying, but it happened to me. Okay, it happened to me a lot. I had
There's
all
a
these
tremendous,
apartments.
you're missing a point. I didn't need a 30-minute dissertation on why it worked. The question is, how much risk did you have? And how much more risk did you incur when the market went down? That's my
Okay,
question.
so when I put leverage on, lots of risk. When I took the leverage away, I had no risk. That's the answer. Thank you.
Right. But you were leveraged, and the leverage got worse, not better, right? Because values went down, they didn't go up.
If I knew what I know today, or I know what where the market is, I would, it would be a different program, because I got, hey, it's a blessing. It worked out in my
Look,
favor.
here's the
I
deal.
never was out
I
of
don't give
real
a shit
estate.
about anybody else on how they want to play the game and leverage and go borrow private money at 6 and arbitrage it at 10. Great, knock yourself out. I don't care. But I'm telling you right now, there's risk in doing that strategy. There's risk in arbitrage, and there's risk in hypothecation. The question is the upside gain worth the downside risk? And you have to answer those questions individually. I'm just telling you what I do. I'm a seasoned real estate investor with over 1,100 transactions. And I can promise you, every single deal I do is this right here. And even if I kept it, I can get out of the deal instantaneously. I can liquidate and be done with it.
If
That's
you
why the
create,
back end structure.
Nick, think about this. If you create a lien at 10% first lien at 72% or lower, okay, and you want to stay in the deal, which you do from time to time, you have an exit, because how many people? Just think about it. Go do an amortization scale. It's the ultimate preservation of capital. Is if you sell that first lien to somebody that just wants a coupon, okay, which is what we buy, okay, on those first liens, and then the thing goes 10 years, we got cash flow. And then if they pay it off or refinance in 10 years or 5 years or whatever, then you get this other lump sum payout, which is your preservation of capital, right? The way we're teaching it is you have no capital of it in your own, because you're getting paid now, paid during the process, and then a lump sum bonus later with little to no risk, right?
Well,
So
let's just say
that's
this
all
was
fine.
let's just say for sake of argument, this was a sub 2 seller finance deal. That's great. I'm still writing the exit the same way.
You're still writing a first and second. That's a number one.
100%.
Because that
100%.
gives
No
you
matter-
the exit and protects all
No
parties.
matter what, because if I have to liquidate for, could be a personal reason, could
Yeah.
be market condition. But here's your risk, okay, by staying in these deals. And this gets back, is the upside gain worth the downside risk? You gotta, only you can answer these questions personally. But here's what I will tell you. The minute, so there's a couple of things you got to remember. The minute I sell that property, the minute that buyer signs that promissory note and closing documents, the absolute second that happens, I'm making money on that deal. Okay, instantaneously. I'm getting paid because it's amortized, and I'm getting paid immediately. I'm generating interest expense. That's number one. Number two, you have to understand is
You're
that
generating interest income, not expense.
interest income, correct. I'm
Yep.
getting the interest expense from being in the bank. But
Yep.
here's the other thing. When we sell the notes, in the way the notes are structured, this number, it's based on the fact that the notes, well, we already know the note is new. So by definition, it's not a non-performing note, okay? Because a non-performing note by definition is 2 consecutive months without payment, okay? That's in the note world. That's the definition, most people's definition of non-performing. Well, if I create it today, the borrower hasn't had a chance to be in it 2 months to not perform. So here's your risk, okay? And this is another question you got to ask, and this is why we teach it and do it this way. There's not a problem until it's a problem, okay? And what I mean by that is, if you're staying in this deal and you're taking all the cash flow from the arbitrage, which is great, I'm not saying you should or shouldn't do it, but if that buyer stops paying, guess what? This is no longer a valid number. If this goes into a slow pay or a no
Default
pay,
status.
default status or something like that, it's no longer a premium payment on that note. Understood? This number might go down to 78%. Now, the inverse is somewhat true. Let's just say you did stay in it and the buyer performed for 9 months. That number could go up maybe to 91 or 92. Okay? Because now you have performance as your friend, not non-performance as your enemy. However, I don't have to worry about any of that stuff if I do it immediately at the time of the closing. I'm dealing with the known quantity. That's the bottom line. Like the market continues to be in influx. Sometimes it's up, sometimes it's down. Sometimes it's up, sometimes it's down. It only matters if you sell, if it's a win or a loss, right? Where notes, it's consistent. It's always going to be the same payment, and you're always going to get paid on it. So that's just my opinion. You can do whatever you want to do with it. Teaching how to get out
You
of
just
the
said you're always going to get paid on it. So that's not
100%. I'm always going to get paid. I'm always going to get paid on it because the banks always get paid. We talk about this all the time. Let's just take this for example. If I buy this note and I'm the bank, or I hold this note and I'm the bank,
Yep.
and I'm in it for $114,000, okay, and the property is worth $180,000, and that buyer goes into default status. Who believes or thinks that the note holder, the bank that's in the first lien position, has a pretty good chance of recovering their investment of $114,000?
Yep.
Pretty damn good chance.
Here's what I will say is if, as you structure these deals, if they are in default, what we do is we always get first right of refusal. So, so what I say is the way we structure it is if there is a default factor, we have systems and processes, because guess what we do? We already have a buyer for this property again. The buyer, we specialize in buyers that 70% of the market is our buyer. Okay. And only less than 5% of the market sells on terms. So if this buyer defaults, okay, if this borrower defaults, we already have an exit, because Natalia says here, a lot of banks don't get paid. It's just called foreclosure. That's true, but it's also, they recoup some, if not all their money, depending on how it's structured. But typically our strategy is go give them their money back, and you already have another seller finance buyer waiting in the wings, because that's what we do. That's the business we're in. We already have an agent right now for this property that's ready to bring another seller finance.
But you guys are already out of the deal because you already
demand.
sold the note, right? So
Yeah.
let's talk about it from their perspective.
Yep.
Let's just say 6 months goes by and the buyer goes into default. Okay. Well, you don't own the first lien position. You already sold it. What do you?
And
You own the
you
second lien.
didn't borrow the money. You didn't form a
You're done.
syndication.
You already cashed out. We just
You don't
sold.
owe anyone any money. It's
No, we don't owe
first
anything.
lien.
We just
It's
made
us, the
$2,100.
buyer of that first lien, that's responsible for that note.
6 months goes by and the buyer defaults or goes into a slow pay, no pay or whatever. You are owed $32,400. Okay. What is your risk on that $32,400? What do you have a cost? Do you have a cost on it? No. Did the buyer defaults? If the buyer stops paying you, who do you have to, do you have to pay anybody still? No.
Nope.
Okay. I don't have to do anything.
But guess
I
what? You
can
get
wait as long as I wanna
notified.
wait.
You're the lender, so you get notified. And then what we do, because we're problem solvers for real estate investors, we're gonna go help fix the problem if it's a short-term problem or a long-term problem.
If
you
we
don't
want
have
to, I don't have to do anything. I'm not at any risk. I have zero risk on there. I might
I
just say,
understand what you don't want to do, but what I do is I'll help solve the problem.
what, maybe that, look, I just gave the first lien buyer, note holder,
Yep.
that I just gave him a freaking 11.72% return on their money at a deep discount to take the first lien position. That's their responsibility. If
Yep.
they want, they got to protect their money.
Yeah.
Okay, I get to go along for the ride if I want to. Now, can I foreclose in the second lien position? Absolutely. Ask me how many times I foreclosed from the second lien position. Never.
Yeah.
Ever. Why would I? I don't need to, because I don't have as much invested as this guy.
Right.
This guy that bought the first lien, he's probably a little bit more motivated. I don't have any call spaces.
But keep in mind, the borrowers that we're selling to, they are they don't have another option to go find another house. Most
That
likely
doesn't happen. None of this happens.
our borrowers rarely default, even in this
Very
market,
rarely.
even in the default, even
That's
even
the
when
whole
crash
point.
happens.
That's the whole point. There's no reason to even have a conversation on it. It's just, we're just explaining you so you understand where where your risk and where your upside gain is, it doesn't matter.
If you bought this as a rental and the renter stops paying and they don't want to pay, and then you go into COVID and they don't have to pay and you don't get reimbursed, you don't have any debt to service, okay? Because of this model, this is the no risk model. You can go risky as you want. That's a personal opinion.
Yeah, so let's go to
But
let's switch over
Nick's
on
idea,
this.
my idea is, rather than risk,
All
I'll
right.
just go do 3 more deals. Now I have the same amount of income with less risk.
So I'm going to switch over to the negative cash model. Okay. And I don't want to go right through it all. And if we have questions at the end, we'll answer them, because I don't want to get off on any tangents, because it's really important to stay focused on this model and this structure, because this is where 80% of the deals, in my opinion, are going to come from. Okay.
Yep.
So
Yep.
I'm going to switch over to the negative cash number. Okay. And what that ultimately means. Okay. Same thing, same numbers, it changes a little bit, okay? 120, let's see what this is. Yeah, so in this model, okay, let's see up here. We're still okay on the minimum wholesale value, minimums, the sale price, we're good there. So that one passes. But now down here, when we get the numbers in, we're negative $8,300, okay? So what does that mean? We acquired the property, we found the buyer, we closed it with the buyer, and at the end of that second transaction, we're negative $8,300. Now, doesn't mean we lost $8,300. It means we're $8,300 in the hole. Okay. I'm going to explain what that means in a second. It's not a loss. Okay. So the other things we didn't talk about on the other screen, the other checks and balances, I would like the net cash and second lien value to be at least $25,000. Doesn't mean it's not a good deal. 24 is fine, close enough. And I like my minimum $350 a day per day on the profit per day. The reason why I use that, because we have a lot of fix and flippers in here and wholesalers. Okay. So my point is that if you want to be able to, if you're a fix and flipper and you make $60,000, but it takes you, 180 days to do it, that's $300 a day. Okay. This is 317 with a lot less headache, a lot less heavy lifting. It's what these numbers mean. Okay. They're just checks and balances. Okay. So when we get to 8,300, what it says right here, if negative, see optional exit. Okay. So a lot of people may not have, well, before I get there, let's just say you did have $8,300. Let's talk about this first, because these deals are happening all the time. My first question is, would you invest $8,300 to get a $32,400 second lien that pays you $278 a month at 9.75%? Is that a good return on your investment? That's the first question. Well, if you have the money, it probably is, because if you look at this box right here, it's 40%. That's just the return when the money is out. Think about it. You still get the back end benefit of a free and clear note once you hit 40, once you hit the 29.82 months, 30 months. Does that make sense? It's really important, because there's nothing that says that you you can use your own money to do this. Okay. But I'm going to show you how you can do it without using your money if you don't have $8,300. Because the question to Jonathan is, in this situation, if every deal cost you $8,300 and you only have $100,000 to work with, how many deals could you do before you run out of money? I will answer the question. It's about 12. Okay. Then he's out of cash because it's tied up for at least 30 months in this example. Okay. Well, that might not be the best utilization of the capital, right? So, but if you have a large stack of cash, this is a great model because there's nothing wrong with the 40% return. Guess what else it is? It's secured by the real estate. Great. And it takes you 30 months to get all your money back. Okay. That's not a bad return. Okay. Let's just say you don't have $8,300 though, but you like the deal. Is this still a good deal or not? Okay. That's what we're going to find out. So if you go down into this optional exit, okay, this right here, what it says is, if net cash is negative, then the second lien value needs to be greater than 3x. Okay. Well, $8,300, the lien value is $32,400. That's 3.90. Okay. That's greater than 3. If this came at 2.5, would it be a deal? Probably not. but you have to decide if you're willing to take that or not. Because I'm going to show you why this model works. So what this says is that if it's greater than that, you can get maximum cash out of the second lien. Remember, we already sold the first lien. That's gone. We already took that money. But now we have this asset that we invested $8,300 in to get a $32,400 note. And now we say, but I really can't afford to put out $8,300, even though the $278 a month cash flow is a good deal. We can't dispute that. So what we can do is that we can sell a portion of payments to get some cash now. Okay. It's called a partial is basically what we're doing. We're going to partial the note. Basically, it's like factoring. We're going to sell. We're actually going to, what it really is we're going to basically borrow, take a loan against the second note. Follow me? So we have a $32,400 note that's at 9.75%. That is a $278 a month cash flow. Okay. And we're going to sell payments on it. I'm going to show you that in a second, what this looks like. So what does that mean? Well, at 42% of the loan value, we can borrow and pledge that note as collateral and get $13,608 in this example and give up that note for some period of time. Does that make sense? Follow me? So now what we're going to do is we're going to get $13,608. Well, guess what? We just paid back our $8,300 with that $13,608. And now the adjusted is $5,308. Okay. Well, that's great, but there's a cost to doing that. Okay. And the cost is we're going to have to sell a portion of that note at a pretty high interest rate to be able to do that. But if you need to cash, you need to cash, right? Yet, it's part of the equation, but I'm going to show you why this is not so big a deal. And if you don't want any cash at all, but you want to be zero, well, then you can just solve for it that way. Maybe you just come in here and you put in whatever the amount of money you need and you sell that amount of payments. So let's just say this is what we're going to sell. So I'm going to go into the calculator again. And I'm going to show you how much you're going to give up and what the cost is going to be on. Okay. So we know it's 32.4 and we know it's that, and we know it's 9.75. So I'm going to show you how much you're going to have to pay on the interest, and you're going to go, holy crap. I'm going to show you what you have on the back end. So let's go in here. It's 32.4, right? It's 278 is the payments. Okay. And let's solve for, let's just say that we negotiate, let's see if this will work. Let's see 22%. Let's see here. Oh, I got to change this. What was the number? 13 what? 13,608. Okay. So if I put 13,608 in the equation, and my payment's not going to change because I'm selling all the payments, and I pay him a 22% return. Remember, it's second lien, it's unseasoned. That comes out to be 125 payments. Okay. So let's talk about this for a second. So what we're doing is we're borrowing, it's actually 13,608. We're borrowing 13,608. We're going to pay 22% effective rate because we're giving them the full payment for 125 months. Now, would we all agree that 22% is a pretty high interest rate to pay, right? But we have no cost basis in it. Remember, we got all our money back in a little bit, but remember, if you're going to take cash out of the deal, you're going to be paying a little bit of cash, a little bit of a premium because the interest rate is going to be high. But let's just finish this equation. So basically what this says right here is that I'm going to give up all my payments of $278 a month for 125 months. Okay. Basically the payback the loan that I got of this amount that I got today. Okay. $278 a month, 125 months. My debt is paid. Okay. All I did was pledge the note as collateral and not take any payments. Follow me? Okay, so let's talk.
Basically, Nick, you're getting a loan against your loan, and this is why I think it'll blow a lot of people's minds, is because if you just want to have zero cost in this deal and build these big, huge second lien portfolios with no money, and then taking a little bit of money out of
this is the model.
What's that?
This is the model, and this is hands down.
Yep.
Model for the next 6 months, because you're going to have to structure these deals, and it's going to cost you something to be in it. But so let me finish this up. I don't want to get on tangent. Okay. So now I just borrowed 13,608 against my $32,000 second lien, right? I just paid it off. So now I'm going to go back and I'm going to go back to the amortization table for $32,400. Okay, at 9.75. This is my original amortization, right? Okay, that should, if I solve that, should be 360. Perfect. Now I'm back to the original. So what did I just do? Okay, I just sold 125 payments, right? I get no cash flow for 125 months, but the note is 360 months, right? So if I go down my original amortization schedule, 125 payments, right? I'm gonna go down to 125. Oh my goodness. I still have an unpaid balance on my mortgage of $29,143.
This is what I was just telling you that just happened to me today. I mean, I'm gonna get paid off, but I'm still gonna get this lump sum windfall of cash on just one deal.
I
Same
mean,
thing.
you guys see what happened? I got to give up 125 months of payments. If it pays off early, there's 2 amortization tables. It adjusts, not a big deal. Okay. That's what the servicer does. Okay. Remember, the servicer is a pretty important part of this process. They're managing all this stuff. Okay. But in that amount of time, I got to wait, but I'm going to still get the back end of this deal, $29,143. So let's just fast forward. I got all my cash now. Let me go back to this thing. So in this example, I got 13,608. So maybe cash now of 5,300 because I paid this difference off. I got to wait 125 months. Okay. When I wait 125 months, in month 126, I get my 278 a month cash flow, assuming it's still in place. If it
How
gets
many
paid
people
out, I
are
get a
paying
little-
hard money? How many people are paying 22% hard money? Put that in the chat.
Yeah, I mean, look, guys, if you don't want to borrow the money, then don't
Nobody.
borrow the money. Use your own money. Because
Yeah.
here's the question. Go back. I don't want to get off on a tangent. I want to stay on this because it's really important. You're much better off funding this 8,300 yourself. It only takes you 29 months to get the neutral.
Hey, Nick, can I just ask, I want to answer one of the questions because this is super important. What happens if the buyer, because it's in line, what if the buyer refis the 125 month? How is that? How's the split between you and the partial buyer?
Right.
You're the note owner. So you're cramming down yours and they're not. So you get all the difference in that deal. That's why it's
So,
such a
I mean, let's
huge
just
deal.
use this example because it's really easy.
This
to
is
show.
mind blowing for you guys, even at
So, hang on.
22%.
Let me open another calculator up here. Okay.
Okay.
Let me open another calculator.
This is what's so cool about this model.
So this is the original. Okay.
You win and win. You're winning.
So 32, I'm gonna create, we have basically 2 amortization tables. Our original amortization table and the new amortization table that we have with our seller. So I'm gonna create the new amortization schedule. We already know the numbers. It was 13,608. It was 22%. It was 278. It was 125 payments. And the payment should be 278.19. All right. So we have 2 amortization schedule. This is our borrowers. I mean, we sold this one
The
and we're
partial.
collecting on this one. Okay.
Yep.
Payments are identical. So let's just say, what was the question?
Let's do 5 years. Let's do 5 years.
5 years.
Yes.
5 years. If it gets paid off early, let's go to this one. This is what we borrowed against our note on 5 years, 60 months. We still owe 10,519. Okay, that's what we owe because we borrowed all that money up front, 13,608. We still owe 10,516. But what is owed to us because it's the second note there. Let's go
Yep.
back to the second note. And let's go out 60 months. 31,236.
So it's 20 grand.
That's the net. That's our profit on the deal. We're done. Game
So
is
at
over. at that point.
22%, you make 20 grand by making a little bit of cash now, no cash flow, but you're out of the deal and you just have a nice little second lien waiting to either cash flow or get a lump sum payout, right?
And that can be any number. Anything short of 125 it's a dual event. Once he gets to 125, because what happens is the note gets all the documentation goes to whoever you sold that partial to, and then it comes back to you by contract.
And then
when it's paid
you
off.
can back, Nick's being very, very, very generous to the partial buyer. But you could, you know, that those numbers are doable, right? People will do that. People will love to make a 22% return on.
I mean, 22% is an awful big number, but point that I'm trying to show you guys.
Yes,
That you can pay 22% and still crush it.
yes, yes.
I mean, seriously, you can pay more than 22%. Because
And-
let's go back to
and-
this. Here's my question. Let me finish this real quick.
Yeah.
Let's just say, for sake of argument, that you change that you had to give up. I'm just going to say 160 months. That's another, let's go, let's say that's another 3 years on that would be what, 161, 125 and 36, 161. Payment's going to be the same. I'm out to say, let's see what this rate's going to go to. 23.45. Would
Yeah,
you give up an extra? Would you give up an extra couple months payment? Let's go back. Let's look and see how much we are owed in 161 months. It's just a calculation. Here's our original number. Let's go out 161.
That's why
months.
the banks do this, you guys. It's front loaded.
You're still owed $27,000 because it takes almost 24, 23 to, well, let's just show it right here. The payment never changes. Okay. At this interest rate in this term, it's going to probably take about 23 years to get to a 50-50 ratio of interest to principal payment being the bank. Okay. So let's just see how,
At
look,
10,
payment
at
one,
10% or 9.7. What are you at? 9.7? Yeah, you're 9.75. There you go. Yeah.
first month, they only get $15 of principal credit. You're getting 263 off the bottom line. That's their principal balance, UPB, unpaid principal balance is going down $15. Wow. That's it. So let's go out and see how long it takes to get to a 50-50 ratio. See how long.
And here's one of the things that I did when I started doing this back in 2004. Okay, when I was buying foreclosure bailouts, I was paying 18% to a second lien holder with his IRA money that didn't need any income. He wasn't looking for income. He was deferring payments. We're actually not deferring. They're getting monthly payments every month from the buyer. So like there's so many ways to, and then I sucked. He did one.
Let's not go on the tangent. Let's get to the
Right,
example.
right.
Then we come back. Really important to stay focused on this right here. Okay. It takes 22.9 years for that buyer to get a 50% pay down on their payment. Okay. You take 275 divided by 12 months. That's that's 23 years. So that's why banks do this. Okay. And we are the bank. That's what we're teaching you, how to be the bank, how to think, act, and be the bank. Because that's exactly what you are in the second lien position here. You are the bank. And you're getting all your money front loaded. You get all that stuff amortized. I could give two rips about depreciation. Could. Why do I get this? Guess what? You got to, first of all, to have depreciation, you got to have something to depreciate it against.
Our amortization is our depreciation and appreciation. That's what it is. Our amortization
You know what?
is.
I say this all the time. If the banks were
And we don't have to
concerned
manage
about-
the dang property.
if banks were that concerned about depreciation, they'd figure out a way to get that too because they're greedy. Yes.
How many loans can one servicer manage without having to maintain roofs and toilets and problems?
All of them, they're performing.
That's right. There's really nothing. There's nothing to do. They just pay.
So do you guys see do you understand how this newer version and where we're going? And we're going to open up the Q&A here. Where is that, like, personally, 8,300? I like me personally, for me to stay in the deal and use my capital to invest, I like this number to be somewhere between 12 and maybe 18 months. Okay. But it really depends, because it depends on what the equity position is. Because if the equity position on this is a big number, I'm willing to keep it there, right? So there's some other factors that go in it, but I know that I can turn my capital faster if it's not deployed, even though this is a great return. 40% is a great return, but I can double my money faster than that. Okay. But you got to have something invested into, right? But, but if I take this money right here in this example, and I'm paying 22% on it, every dollar that I'm borrowing, basically I'm borrowing it at 22%.
Yeah.
It's really the calculation on it. Granted, I was given the money because of the way the structure of the deal, that was my profit, but it's still 22%. So you might want to come in and, and structure this so that you don't take that much money. You might, I don't want to change this formula, but let's just say you come in and you only need, let's just change it to 30%. Because no one says you got to take 40. Okay. Now look what happens. Now you only have to borrow 9,700 and get 1,400. So now if I take that same example and I go back into the calculator, let's just put it in there. Let's just call it 9,700. And then I'm going to open it to questions. So let's just call this $9,700 now. Payment, remember the payment doesn't change because the payment never changes. This piece here. And now let's change this back to 22%. Now let's see how many months I'm in it for. 57 months. Think about that. Now I'm only paying.
You basically have little to
years.
no principal pay down on their end, and all your principals pay down. You're just front loading the payoff of your deal. It's great.
But here's the thing, what I'm trying to explain to you guys is, even though this seems extremely expensive, you're playing with the house money because you created basically a free and clear second lien out of thin air. So you're getting to play with house money, that's
Well, you're finding a property at wholesale price, selling at retail, and that's where this all comes into play, right?
But from a risk perspective, there is no risk.
Right.
Because once you sell that first note and pay off the underlying debt, you're in a cash, you're in infinite ROI because you paid that off.
Guys,
All right, so
put it
let me
in
finish,
the chat. Please put in
hang
the
on.
chat like what your biggest takeaways on this call, because we had over almost just on the call alone over 50 some people on the call. It's super helpful for us because then we can provide more value to you guys as well.
So I'm going to go through a couple other things on this spreadsheet, then we can open it up to specific Q&A. Anybody has any questions and stuff. So the other things that are on here that are maybe different. These are just some of the links to some of the stuff that we have. Okay. The case study video, that's the original one we did. Resources is here on the spreadsheet. The tutorial video, which is this video that already recorded. Cash flow deal machine is how you get this.
Hey Nick, is that new tutorial video, is that live now? Because I know you made it change and it
Yes,
wasn't live.
it's on there now. So
Okay.
the one I recorded, if you go up here, let's just see
Yep.
if it works. Let's see what happens. You got to click on it right here. It was working yesterday. I don't know why it does that. We'll have to check into that, Elvia, and find out why Loom keeps doing this, because I checked it yesterday and the video's there. If not,
Let's just import it into our YouTube channel, and then that's well to go there as well.
Yeah.
So that's okay. We'll figure it out.
here's the
I
video.
just want to make sure.
Here it is right here. Let me see if I copy this link. Here, I'm going to put it in the chat, and then let's see if it let's go to the chat. Let's see when you guys click on it from the chat if it works or not. If not, Loom has been having some issues recently, so it's on their side. And if not, what we'll do, Elvia, is that we'll download it and put it in on the drive, and then put it in the resources as well. Okay.
But it also can be
All
our
right.
YouTube channel.
Yes. So that's the actual link. And so sometimes when it gets embedded in the spreadsheets, it might not work. If somebody can get that and tell me if it actually works or not.
I just clicked on it. It does work if it was in the link. So if you guys just want to save it.
Yeah, I don't know why it doesn't. It's sort of like Facebook. When you go to links inside of Facebook, it doesn't like it for some reason, but this is the link. Okay. So there's the link, save it. Elvia, I think I actually already posted it in the Facebook group when I posted it, but this is the link. For some reason you have it. Elvia, let's just make sure we download it.
Facebook has just about everything you guys will ever need in there. So just so you know.
For now. All right. So let's go into, let me shut this, shift back over to the model, and let's go ahead and open it up to some Q&A. Okay. And see what we can answer on this.
Me.
Oh, here's Stacy. What does Stacy have to say?
So I am, I like to do deals with people in our group, people that understand this model, okay? And there's somebody in the group, if he'll unmute himself, it's Amory. Are you there?
I am here.
All right, so let's
So-
spotlight both of these guys, Eric. Let's,
Okay. Where's Amory?
so
Okay,
they
I'm
can-
gonna do it.
And
Give
then
me the-
also, I kind of want Susan to put her 2 cents in here as necessary.
Okay.
She can just unmute.
I'm gonna stop the share for right now. So
I'm
let's get-
unmuted.
See if I can add him as a pin. Add pin.
I think we're all there except for Susan. Maybe we got a max out number here.
I think I
don't know.
gotta add, I think I had a pin.
She
on my
doesn't
thing.
have video.
Oh, she doesn't. That's why. Yeah. Okay.
I pinned everybody, so you should be able to see them all there now.
Yeah, I did that too.
All right, go ahead, Stacy.
So he's got a deal where, of course, my dog hasn't been barking the whole time.
Oh, we don't have,
So
it was
he-
Amory. Is that who you said? Amory?
Yeah.
Okay, let me add him to the thing. Okay, there's Amory. Okay, good.
So he's got a deal that he's working on. He asked me for 130,000, and he's buying the house at 130,000 and hopefully wanting to sell at 190.
Okay,
So, if you quickly think about it, you quickly put it in the numbers. I looked up the ZHBI. ZHBI is 189, so he's right there. At first he's looking for, just private money for whatever, 60 days or so. Okay, fine. But and one question I was just asking him in the chat is, it's already been up for sale for about 189 for over 100 days. In my mind, what's wrong with this picture and how does this work in the model? And, okay, maybe instead of just only being the private lender for a few days, maybe I want to hold the first, maybe I want to own the note.
well,
Yeah,
you
that-
will be the first lien holder anyway, if you're gonna.
Well,
Be a lender on it.
technically,
So here's
yeah,
my
yeah.
first question is, so I could care less if it was on the market for 900 days. My first question is, was it on the market with the ability to purchase with seller finance?
No, it was
No.
not. He
Because
said
we talk about this all the time.
different perspective.
70% of the marketplace can't get traditional financing.
Yep.
I don't make this stuff up. I mean, it's 60 to 70%, pick your number. We know that less than 5% of the market is available to be purchased with seller financing. So unless now here's what I would probably do if I'm in this situation, because that is a red flag, right? That is a red flag because somebody probably could have bought it. Okay. So here's what is the house vacant?
Yes.
It is.
So personally, what I would do, this is what I would personally do. I would get it under contract and I would market to a buyer. And I would to an owner finance buyer, and then I would solve it backwards. And I get the buyer first before I did anything with any kind of money whatsoever. Because if you could solve it backwards and you do get the $190,000 buyer and they do give you $25,000 and you know that answer to that question already, does that change your opinion on the deal?
So where we're at with it is I found
Where
on
is this located anyway?
it's in Salisbury, North Carolina. It's about 25 minutes north of Charlotte.
Yeah. Okay.
And so it is underneath contract. I put in the earnest money deposit. I found it on the MLS. So it's underneath contract and I'm marketing it now to a tenant buyer right now on Facebook. We got a couple of bandit signs out. And so I definitely wanted to put the bar in place before I even asked Stacy for some money just in general. But that's kind of what we have in mind. And what I'm thinking is, because she's interested in holding the first on the note and kind of being a private money lender, I'm curious if I could just like pay her some points for being the first position note buyer and kind of structure it that way. If that makes any sense.
Let me
Well,
just
the short answer
pipe
is
in real.
yes.
Let me just pipe in real quick. Those are that is the perfect scenario. That's perfect storm. You have your long-term lender as your acquisition and disposition lender. That's the perfect storm. Nick and I do this quite a bit. And so if that's where you want to be, then that's a nice starting point. Now in Stacy's deal, it's like, okay, I want to make sure, you know, you're getting 100% financing. So you're doing the right thing. You went and found the house. Now you're going to go find the buyer, and then you back in, and it's like a double escrow type deal. And then you're just in and out. And then Stacy stays in on that long-term note, which if that's her strategy, it's a great strategy. It's a great strategy.
Sweet.
Yeah. You know, I would probably treat it as two independent transactions, Stacy, because
Yeah.
one is a lender, one is a short-term lender transaction, the
Yep.
other one, long-term hold.
Yep.
And
That's why I know I understood the point where I'd be the lender and the first note holder, and that's why I kind of was
is
separating
the
those.
money in the same account? Meaning, is the money that your capital that you use to invest, is that the same entity that you would hold a long-term note in, or is it
Yes.
different? Okay. And it doesn't really matter, just how it's structured. So we would just do a release of lien, and then you would take that, you would in
Yeah,
the
you
purchase
go
agreement
from
on the
you
note.
go from one lender to the other. That's it.
Yeah.
And you're going to
It's not
charge
that hard.
accordingly on the first acquisition, hard money, and then you're going to charge however you do on the first, when you become the long-term lender, which is whatever discount you're going to pay and all that. The best part, Amory, it's Amory, right?
It's pronounced Amaray, but most
Amory.
people.
Okay, Amaray. So
Yeah.
no, the best part is when you're direct to seller, you have, in this market, you've got all the opportunities in the world to make work, and just, you know, rinse and repeat, you know.
Well,
Excuse
question
me.
for you all, because you know the most important person to me in all of this is Stacy. So I do have it structured at 78% on the first, and so just on you all's opinion, would you?
That's too high,
That's too high.
too high.
Yeah,
Okay.
I would be,
Now,
she
here's
needs to
why
be
it's
down
too
at
high. It's
72,
only
maybe lower.
It's only
Okay.
too high because you don't know the answer. Okay. Now,
Okay.
if you get the buyer and you sell it at 195 and 25 down, and then you put it in the model and that works, then that's fine. But you don't
Okay.
know the answer yet, right? So that's why I'm saying, because if you model it at the 72 and 88, because you got to look at it from Stacy is going to be both a short-term lender and a long-term note buyer.
Yep.
And I'm not going to speak for Stacy, but I'm guessing two of the things that she's looking for as a note buyer is the yield on the note and the risk, right? Those are the two things.
Yeah.
So that's what's going to determine on what she's willing to pay, what premium she would pay for that, and how well it's underwritten.
And she needs a little bit of a discount because she wants to make sure if the note gets paid off in a year and a half, she makes money there too. Because I mean, I have a guy who does 50 million a year, and his average notes they're not our type of buyers, so, but they average 1.5 years, but they're just different buyers. But anyway.
Look, when you get to that
Excuse me,
point, you
may
think
I-
you can.
Oh
Go
yeah,
ahead.
hey, Susan.
May I give my opinion?
Yes.
Sure.
I would rather see a first and second with a deep discount on the first, and then the second, Stacy can buy a portion of it so that it makes the deal, as opposed to her holding the first for long term. Because it concerns me, Emery, how much experience do you have in real estate?
I've been investing for about 3 years, and I've.
So Susan, why does
hotels.
that matter? I'm just curious. I'm not saying it doesn't matter. Why do you think that matters?
Well, because some people on this call do not understand that a second loan, a second lien, usually you only get 50% if you sell the whole thing.
Why
And
why
here-
is that? So Susan, your experience, I'm gonna keep asking the question.
Okay,
Why is that? Let's just peel this thing back. Why is that?
because usually second liens default
And why is that?
because the buyer has not been properly vetted.
Oh, really?
And that is why I was asking Amaray how much experience he had with
But
vetting.
guess what Amory's not doing, Susan? He's not vetting the buyer. He's not underwriting the buyer. He's not servicing the buyer. He's not writing the promissory notes. He's not even managing the transaction. Because if that was the case, I would agree with you 1,000%. Okay, But
That's
all
why
those
they
things
sell
don't
for
exist.
50%, because these aren't clean notes. They're written on the back of it on a napkin. They're not run the way we do this. That's why this course exists. That's why Nick and I exist, for this reason.
you're 100% accurate on that. And that's exactly why we do, like Eric said, why we do this, because we want to eliminate the risk.
Yes.
That's why Fortune 500 companies buy the notes, why hedge funds buy them, why financial institutions buy these notes, because there's not a bunch of scratch and dents and unknowns on the deal.
The
Now,
paper's
but I would
written,
tell
the
you-
borrowers are underwritten. That's super important, super
But the
important.
asset's just as big of a deal as the borrower is. Because at the end of the day, the asset needs to stand on its own, in my opinion. I much
Correct.
rather have a newbie that's never written the deal write a 50% LTV first or ITV first than somebody that's done 1,000 deals and write it at 95%.
Correct. Absolutely.
And
But I
real,
don't know-
real quick, Susan, I just want to interrupt because I want everyone on the call to understand your 50% of the first, second lien and the returns and all that, that's personal. That's not everybody. So it's not fair to say that the general, that you can say the general market pays that, but I have guys that'll give me 100% on first liens and get 8 to 10% because of my experience. And they also, maybe I cross collateralize. Maybe there's a lot of unknowns that
Yeah.
I do in order to do that. But it's your general opinion on second liens is accurate, but it's also it's not fair to say
It just
that they're-
depends.
Yeah,
It just depends. That's the whole
Yeah.
point of it. But you're
Yeah.
right. When you do the initial evaluation, you're making that assumption before you even look at the collateral file, what it's already going to be. Because 95% of the stuff that's written out there, Susan, is exactly how you described.
Yes.
But what
It's
we're doing
garbage.
is trying to show percent resides. Because if you can get to the 5% that's the premium paper, it's worth every penny of it.
Nick,
So
Nick and
we
I
have to
just
do a
had an
really good
example
job of
today.
Vetting that buyer from the beginning.
Nick and I just had a discussion today about an RMLO charging $1,850 or whatever. And then we're like, God, that seems awfully high. Well, what if it costs you $8,000 in discount because you didn't do it correctly? That's why the national averages are low, because they're not written right. And all of this is the best thing that Nick said, is you're not doing any of it. Your professionals doing all of it. And that's what makes your deal. So when it comes to Stacy, once all that's done, then it's up to her to make a good business decision to get that cash flow or not. That's it.
Correct. And that is why she has offered to people who have bought your course, who are doing it your way with the RMLO, with all the paperwork that is done by them in accordance with your rules, instead of buying a second note outright, she will buy a portion of it. Therefore, they have the money to complete the deal, and she gets the payments for the first however many months, and then they get it back. I
Yeah,
think
so
that
if
is
she's the
the
first lien
way.
holder and the partial holder, that's a really good risk.
Well, and the best
Great.
part of it, the best part of all this is that you just create it any way that you want to create it. Like
Yeah.
on paper, you create it. Go, look, I want this to be this. I want a 52% first and a 19% second, and I want the rest to be in down payment. And I want the first yield, the first note to be at this value and the second to be at that. And then you go solve the math equation. It's not hard to do. And that's all we have to do. So when the buyer goes to, basically what happens is that we find a buyer, they go to underwriting, we approve them as a borrower, right? And then we go and we structure the deal before we approve the buyer. And basically what Stacy's doing in this case is she's putting an indicative bid on the note that's going to be created. Because she's already
Correct.
seen the buyer file. She creates it, we create it any way that she wants it, because it's her money in it anyway. And it doesn't have to be 72 and 88. It could be whatever numbers you want it to be at that point in time. You control the whole thing, and you just back into the equation. And then it's up to Stacy and Emery to figure out how they want to partner together to make the deal work, and everybody's protected. So there again, this is a little bit more advance. But what I wanted to say though, to Susan and Stacy, is that as we release the 2.0 version of what we're doing, and we bring in that certification, what I was talking about, that's exactly the reason why we're doing it. Because we need the note buyers, and especially the partial buyers in the back end, they're gonna want to know what somebody's done and did to make this so they don't have to go read every page of every paragraph of every page, because
Right.
that's not efficient use of the time. We're acting as the intermediary on behalf of the buyer, the note buyer in a lot of ways, and they're vetting us in the process, not necessarily you and the asset itself. That's the reason why it's done that way. And that's when we've done all this already. Like I already went through this exact same process that we're talking about when I sold the company to the bank. Been 11 months going through this whole process, man. It's a pain in the ass. So, but all that inconvenience that I had to endure means I've been vetted now. We've been vetted. Guess what? It's the benefit to you guys. And now we're taking that, and instead of me personally, Eric personally, going and creating 500 notes a year, which we could do on our own, we teach other people how to do it and still put it into the same infrastructure. Because the process that you guys are going to go through, if you want us to be involved in this deal, is the same exact process to a T on exactly how we would do our deals. They go through the same way. They use the same infrastructure, use the same process. They come out the same. The only difference is who the lender and seller of record is. Instead of it saying my name or Eric's name, it says your name. That's the only difference, because we're not going to let you do the deal if once you're certified. We're going to say, you can't this deal. You can do the deal, but understand what the outcome is, and so on. So enough with that. That's coming in October. We'll be here in 30 days, and then things are going to change quite a bit from that perspective. Because I just showed you guys. Look, I just showed you. Let me see if I can still share the screen here. I think I still have it up.
Did that answer your guys' question,
I don't have it.
Stacy and Susan?
Yes, I think your system is excellent and I really appreciate it. And I just wanted people to understand that there are other ways to make deals work than just taking money out of their pocket, but it will cost them in time and energy to make sure that every I is dotted and every T is crossed. Thank you.
Thank you. No, we appreciate that, because it's important, because what most people are not on this call, they're not experienced note buyers. Okay. And there's a big difference between being a note buyer and a real estate investor. It's a big difference between being a bank and fixing and flipping a house, right? Banks lend to fix and flippers and land. That's all we're doing. We're lending into it after the fact. Guys, and here's what I want to visually show this right here. That one deal, and here's a question you need to ask yourself. That one deal I just showed you is $32,000 and potentially $30,000 in perpetuity over 30 years. What's it? That's one deal. I mean, I don't even know what we charge for the digital product now. $1,500? Is $1,500?
It's $1,997
worth it?
It's $1,997. It's going to go up too.
Well, it's gonna go up quite a bit, but right now, is a $1,500 investment worth the ability to get certified and be able to do this deal and then have
1997.
people
not
like Stacy and
1,500.
Michelle in the equation? Because that's what they're buying. They're buying the note because if they're gonna invest and be at risk, they're gonna make damn sure they're in a as good of a risk position as they possibly can be in. That's why this is worth way more than what you could ever do, because we just showed you how to do it with little to no money out of pocket. And if you want to invest in it, like Stacy and Michelle's, you can do that too. If you want to stay in your own deal and take, $8,300 and invest that money to get a 40% return, nothing wrong with that either. There's just
but Stacy and Susan, their daughter and mom, but I like what Susan said. She's like, hey, why don't I just do the first lien and I'll do a partial on the second, and that limits my risk as well. So that was really smart. One more thing is
before you go on that, because it's really important. guys, this was very high level, very deep, but remember, there's only 4 things that you need to do. Find the deal, analyze the deal, fund the deal, find the buyer. All this stuff that we just talked about, you don't need to know how to do it. There's a who that can do it all for you, and you need to use the who to get to the end strategy. You don't need to know how, I don't even know what that means. How am I going to structure the first and the second, and how I'm going to structure the back, blah, 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 blah. You don't. You just need to have somebody do it for you so you can exit back out of it. Now, at the end, if you want to go shop the deal, you want to go shop this deal right here. Let's just go back to this right here. I think it was this one. And you know what? You go, I don't want to pay 22%. I'm going to go find my own investor and it pays me 15%. And I want to get, $14,000. Okay. Well, great. 1,400, I need 14,000. Great. Go find your own buyer for that. I'm not saying we're not going to be the buyer on all this stuff anyway. We're just telling you how to structure it so you get premium pricing, because there's a big difference on what you're going to do. Because if you don't do this is there's no guarantee in doing what we just showed you that you're going to get it. That's why it's called forecasting. However, I will tell you this, you have a heck of a lot better chance and higher probability of getting closer to what you want to get by doing this than if you don't.
Hey, Nick, real quick. So
Yeah.
that's a great segue, because when we say premium pricing, you get premium pricing because you do it the right way. That's number one. Number two, Mike Graham asked, what is the certification? The certification just simply is when we update the program a little bit. And if you already buy it and you're grandfathered into that, it's really is, if we go into the program and find out you have 2% of the course completed, you're not certified. We want you to go through the whole thing. That's why we did it. That's why we did this. It's not, for the price that we're charging, clearly we're not getting rich off this stuff. It's to create the model so you guys can get premium pricing, so we can help buy your notes, or at least teach you how to go and exit out of these notes. That's why it's done. So the completion of the course is your certification. We haven't quite, figured out exactly when we can actually track it, but that's basically the short answer is just go through it and learn it. And so we can help you be successful with this. That's
all this stuff's available for you guys to go. We show you how to do it yourself. I will just tell you from experience, it's not worth the squeeze to do it yourself.
No, it's the who. We're helping you find the who. And then obviously Nick and I are in this business. We do deals every day. So every time there's something new or cool, or a new servicer or a new something, we're going to share it with the group. And so as we grow, we're going to have to minimize that so we can actually handle it. So anyway,
all right. Well,
I hope
let's wrap this up. If we have any other questions, let's get them answered. If anybody's got another specific question on what we just talked about, raise your hand and we'll just ask it, and then take a couple more questions, and we'll cut this off in a couple minutes. Okay. We got Kevin. Kevin's got a question, and then we'll go to Kevin, and then we'll go to Stacy. So let me, so Kevin, why don't we bring Kevin on?
I'm on.
All right, Kevin, what's your question, buddy?
What's the difference between the program, that's 1997, and this thing about working with you guys? What's the main difference between those two things?
Well, there isn't really any difference but for you to be able to work with us directly, and for us to help structure deals and help facilitate and ultimately be a buyer on the note, you have to go through the digital program, and so you know how to structure everything that we need to get to our point. That's the first sort of thing. So we won't look at a note, like if we don't create the note or help you create the note for us to buy, we really have no interest in the note. Okay?
That's the working with you part, is if you guys did everything the way we teach you how to underwrite and actually do the deal, that's where it comes in, because we're interested in buying the notes, doing the partials, and helping you exit out of these things. That's where that comes into play.
Yeah, the value to us, look, we love you guys, and we don't have a problem sharing 2 hours a week with you guys, but at the end of the day, the end game is for us to buy the note from you. I'm telling you right now, and to give you as most as we can give you for that note if it meets the criteria that we set forth. Okay. And so we want you guys to create the notes so you can get paid your piece of it. We can stay in the deal long term, but it has to be our way because, like I said before, 95%, like Susan was talking about, 95% of the notes that are created are done incorrectly because of that 84% of all seller financing notes they're one and done note creators. I can promise you they have no idea what we're talking about here. They just wrote it on a napkin and told the buyer to give them $500 and give them $100 bills at the beginning of the month. Seriously, I mean, that's how a lot of that stuff goes down. And there's no track record or stacking in the file. That's the value. That's why we do it. And if you're going to sell it to a financial institution, a bank, a fund, guess what they're going to want? They're going to want everything to be absolutely perfect, and they're willing to pay for it because they're going to get the benefit of it over time.
And there's no reason not to do it because it's just paperwork in a process. That's it.
So I think,
You don't-
so I
you don't
think
wanna
what
get
I was,
lazy.
what I was asking is, I think I saw an email from you guys where it looked like some sort of application process for some sort of mentorship. That's what I was asking. Is that different from the 1997 actual course, the program? Or is that the same thing?
No, that's a different thing, but we're making some changes in that. So I would strictly stick to the digital product right now, as well as creating the notes. And then when you have the notes, when you have it ready, then that's when we would come in and help you.
So I
Yeah,
have
I think
three,
that-
so I have three houses that I bought. Two of them
Okay.
are subject to, and one I bought for cash. And
Okay.
I'm now in the disposition phase. So that's why I'm considering coming on with you guys and figuring out how to create those notes. And
Yep.
I looked at everything today. You didn't talk about subject to stuff. You said that's coming in 2.0 because I have two
Well,
of
it's
those.
not for this call. Let me just put it that way.
Okay.
It's not for this group. It's a more advanced strategy. There's obviously risk involved in that.
Okay.
We're teaching a low to no risk, high return, infinite ROI model. It doesn't mean those other strategies aren't good because they are. It's just not the same. It's like
We're-
comparing apples to car tires.
You
right? I mean,
can
they're
plug in the numbers and a sub two purchase and keeping in the deal and creating a first and second, and then you can decide how much risk you want to take for that deal. I smile when I say it because there is risk, and I've been very, very successful because of those risks, but there's risk. So that's the
Yeah.
difference.
What we'll probably do, just a little bit of a preview, is once we go to the 2.0 version of the digital, and if you already own the digital product, you'll get
Yeah.
everything included. You don't have to, there's no additional fees, no different upload grades. You'll get all of that. So there
It'll
won't
just
be
get
any-
added. It'll just get added to the.
But once we release the 2.0 version, then the previous material plus the new stuff is that once you get through the completion of that, then you'll get certified. And once you're certified, which is a fancy way of saying that we know that you understood the base concept that we do,
completed
then
the program.
we'll have additional meetings like we're having right now for the certified membership.
Yeah.
That will talk about the high level stuff. Hey guys, you got to learn algebra 1 and 2 before you go to pre-calc, before you go to calculus.
Yeah.
Okay. Sub 2 is a calculus, right? This right here is more entry level math, right?
Well,
You gotta
no, but
understand
structuring a
level
sub
before
two
you go.
deal on the exit is really, really, really important, and not
100%,
people are
but
doing
that's
it.
not what we're talking about with this right here.
Yep,
That's
yep.
going to be the value add on people that take the time to go through it, because there's a lot of people that teach creative financing and specifically sub 2, but none of them teach what we're touching. That's why go learn from, there's way better people out there to learn sub 2 from. I can tell you that right now. I mean, I see stuff all the time, but at the end of the day, you got to understand how to structure the back end to protect yourself in the end game. And only you can determine what level of protection you need, right? If you're driving down the road 100 miles an hour and you don't wear a seatbelt and you get an accident, that could be a problem. However, if you're riding your bike 2 miles an hour and you're riding it on the grass, what do you need a different level of protection? Probably, less likely to get hurt.
I-
That's all we're
what-
doing here.
Get what Nick's trying to say is when you do, if you do sub 2 and you create a first and second, you create the first at a good number that you can exit out if there's a due on sale, which is why you would do that. So you don't lose all the hard work and equity you created in that second lien. And
Yeah.
that's the point of this. And no one's talking about that right now. So it's really important.
Yeah.
And share, hey, guys, share our Facebook and what we're doing with your community because it's super helpful. Like this is why we do that stuff. So
Look,
So-
let me ask Kevin one last question. I get to
go
start
ahead,
gonna
Kevin.
wrap up.
Kevin had
Kevin.
another question.
Kevin, how long you been in this group? Listen to what Eric and I have been saying.
About 2.5 months.
Like 2.5 months. The properties that you got on sub 2, did you find those before or after you started listening to what Eric and I were talking about?
One of them before, one of them after.
So what was your initial strategy before you heard Eric and I speaking on how you were going to exit on that sub 2 deal? What was your initial, when you thought sub 2, go, great, I'm going to take this down and then I'm going to do what with it? What was
On a finance wrap
wrap on
and-
the
and
finance
the-
it? Okay.
and the arbitrage of the interest rate because I have it at 3.125, sell it for 8.99 or whatever, and
Got
the
it.
arbitrage on it.
Stay in the deal as long as you can and hope that
Yep.
your buyer pays.
Hope that, yes.
Yeah, that's one of my favorite business strategies is hoping and praying. I don't know I don't know if that goes on the P&L statement. I'm just teasing, right? But no,
Yeah.
but in all seriousness, you have to be able to solve it. You have to have a
Real
way
quick,
to solve
what
the
you just
problem.
said there, what you just said there, Kevin, was you have a 2 or 3% 30-year fixed loan that you're taking over and you're going to wrap. And you're like, well, if I just double that, that's a good deal, right? You would think I'm going to do it at 6 or 7 or 8. Well,
Yeah.
the reality is what if there's an event and you have to pay off that first lien? How are you going to sell the first lien to a note buyer that wants a 10% yield? You're gonna have to write a big freaking check. And
Yeah.
that's why we
Yeah.
teach this because people aren't doing that. That's the advanced side of this. It's so
Doesn't mean you
important.
have to write it. Doesn't mean you have to do it, but you need to be prepared to do it. Because let's just say you wrap the mortgage. Let's just go to pre Eric and Ed. In the event, so I don't, and you don't have to answer this financially, but the only way you can cure a problem, the only way you can cure a problem in a sub 2 transaction is to pay off the debt. Would you agree?
Agreed.
Agree.
The
So
bank
one way or
wants
another,
the
you have to
money,
pay
the
it off.
seller wants out of the deal somehow. If you pay it
You
off,
know,
no one's harmed at that
Paying it
point.
off probably cures 99.9% of the problems, right?
Yes.
If you pay it off and you put them back to the position you were gonna, if you would have paid it in the beginning, you're probably gonna be okay. I can't predict the future. All I know is that anytime I've ever been addressed with that situation, paying it off solves the problem. So the question is, great. So if you know that paying it off solves the problem, okay, you have the ability to pay it off. Okay, so if you can pay it off, great. But not everybody has $150,000 to scratch a check to pay Wells Fargo off on unpaid balance on a note. Okay, but you know what? Maybe you have to come up and borrow because if you write that second note again and you're $10,000 short on your arbitrage model, and then you sell the first to pay off the Wells Fargo, and you have to go borrow 10 against your second note to bring it to 0, you're still get to stay in the deal long term.
Yeah.
You can at least you get something out of the deal.
Which
That's
is
the
exactly
benefit
why
of
I'm on
gold.
this call trying to figure out the better way to do it. So I had a
Well, I don't
decent
know if it's
way.
a better way to do it. It's
Well,
just a
less
different
risk.
way to
Less
do
risk
it.
is better. So less risk is
But
better.
but maybe it is, maybe it's not. Some people would argue that. I don't look. I know people right now that do creative financing. They do their own title work. They service their own paper. They write their own contracts. They don't do anything that we talk about. But you know what? They don't care. And the reason why they don't care is because they sitting on $5 million and they do enough deals. They can just cure the problem. I have a good friend of mine who's done thousands of transactions, and he told me a long time ago, I don't get insurance on my properties. I go, you don't get insurance on your properties? What are you, nuts? He goes, I could literally have had 10 houses burned to the ground by now, and I'd still be way ahead of the game. So it's all relative, right? You know, that's why we have insurance, because the one time you don't have insurance is the time you need insurance.
Yes.
Can you afford the downside risk relative to the upside gain? That's all that we're talking about here. If you only have one sub-2 transaction and you have no other way to finance that deal but that one transaction, and it goes into a bad situation, can you get yourself out of it? Because if you had 20 of them, you could take all the benefit of the other 19 and solve the problem for the one, more than likely. But you got to have them to do it. So anyway, Kevin, let us know if we can help you on that. All right.
Yeah, so that's what I want to figure out. I get into this
Yeah.
program, I can get help with this stuff that I'm going to do right now because I have the 2.
100%.
Yeah. Okay. So
Yeah.
I'll put just.
I mean,
What state are
shoot,
these in,
between
by
the
the way?
digital
Where-
product and being on these calls, I mean, what else do you need, right?
Yeah.
What's that?
We're-
I didn't hear what you
Between
said.
the
Eric.
digital product and being on these calls, what else do you need? I mean, we're really, that's what we do. That's why we do it for the many, because it's every time we talk, just what Nick just said, probably brought up an answer to somebody's question they just had. So this is why we do this.
Hey, one last question, Kevin, because we got to get out of
Yeah.
the call. We're supposed to be
Susan
on.
has one more call.
Kevin, last question, Kevin. Where are these located? What state are these in?
All in Georgia,
Okay, good.
Waycross, Georgia, Hepzibah, Georgia, Macon.
Okay, good. Have you started looking for your owner finance buyers yet? Just curious.
I have one of them that's been on there for 60 days. Well, actually, it's about 70 right now. And it's not, I mean, I had a ton of people interested, but nobody has 10%, you know.
Okay. Well, we can restructure. Maybe you got to take 5 or 6 or 7. Nothing wrong with taking less, but you got to understand that you're going to have to do something on that back end to bring it. 'Cause you're gonna end up.
Yep.
Now, if it's an arbitrage deal, you might roll the dice a little bit, but you got to understand what your risks are doing that, right? You might say, because at some point in time, payment performance of the payment will override the down payment on the deal. So that's a whole nother discussion. All right. Last
All right,
question,
thank you.
then we got to roll. Susan, what you got?
Do you require an appraisal to sell a note to you?
So what we're doing, so up until about 45 days ago, the answer was no, because we knew that the value of the properties will continue to go up and we would be okay at the investment, the value. So what we do now is that we need some verification of value in that model. And usually we can do it with the BPO, or sometimes we can get away with true sales comps that are a little bit more defined or refined than a traditional appraiser would use. Because there again, if you say it's $200,000 and you sell it for 200, but we do the value and it comes in at 190, then the indicative bid to buy the note is going to be based on the value, the true value, not the sale price. So, and that's going to happen up. So that's why, to really protect yourself as the note creator to get maximum value, we're going to highly recommend that you get a BPO or some really solid valuation so that we can leverage that against the note buyer. Because you're a note buyer, or do you need to see an appraisal or a BPO? Or are you going to do your own
Yes.
comps on that?
Yes, I would need to see it.
You would do it. You wouldn't do your own evaluation, because a lot of note buyers just do it themselves.
No, we need a BPO.
I would recommend doing it, because guess what that is? It's a third-party verification and validation of what it is. Because as a notes, if I'm the note creator and Susan's the note buyer, okay, and Susan goes, well, that house is not worth $200,000. I think it's only worth 170. Okay, well, great. I don't think that's true, because here's my BPO or appraisal from a certified whoever did it that says that's the case. Who's more likely to be accurate? Susan, the unsophisticated appraiser. I'm not saying she's not smart. She's not an appraiser though. She can go to appraisal school. She didn't understand all the rules of appraisal.
Maybe Susan did. She's done a lot of
Oh.
things in her life.
I'm using it as an example. Stop yelling at me. You understand my point? So that's why we do this kind of stuff, because we want to put it in the hands of the experts to eliminate subjectivity. That's why when we write and stack a borrower's file and we do all this crap, it eliminates subjectivity. When you underwrite the buyer, you don't have to assume
Hey,
what they
Nick,
are.
we
Yeah.
have another call 5 minutes ago, and I want to answer one more question, then we're going to hang up. And we'll see you guys next week.
Actually, we will
Somebody-
not, hey, stop for a second. We will
What?
not have a call next week.
Oh, that's right.
We're gone.
We're in a
We will
secret
not be doing a call.
underground place that we're going to
We
learn.
will
more
not be having a
guys
call
later.
next week. The following week, we will likely have a call. Because we'll probably do it towards the end of the week after we understand where we are on the update on the 2.0 and what's going to happen there. So we will definitely not have a call next week. Sorry about that. I should have
I
said.
just want, yeah, I appreciate that. So, real quick. So, question was, I take over house sub 2. This is advanced. I create a first and second. I wrap over the first, and all of a sudden I take access to that arbitrage from the low interest rate on the sub 2 deal. And then all of a sudden I need to sell I need to sell it. Well, if you create a 10% first lien at a good loan to value, that's how you would sell that first lien to another note buyer, and that's how the first lien gets paid off. So that was my Reader's Digest version for Zach in that question, which it's all in the Academy. So that's it.
Yes. All right, guys, we got to roll.
You guys are awesome. Thank you so much. This was a great
All right.
call. I
Have a
appreciate
good one,
you.
guys. Take care. We'll see you
All right.
soon.
See ya.
All right.
Bye.